But we get it free, I think.
Oh,
I'll have to go check.
He did tell me he was ready, but doesn't
He
hurt
did?
to check. Yeah, I'm not sure when the ready starts.
That
Thank you.
is like a physics major, spoken truly.
he's
I feel
either
like I
ready,
need a
he's
little
both ready and not
walking time
ready?
with him.
Is that what you said?
Okay, we're starting.
Yeah. Okay, I think we're ready to get started. Let's start off with roll call, please. Judy?
Mr. Lekowick is absent today. Ms. Cavanis? Here. Mr. Haschak?
Here.
Ms. Harris?
Here.
Mr. Swope?
Here?
Ms. Cubison? Here. And Mr. Land.
Here.
Thank
Okay, I
you.
would like to ask Trustee Jerry Harris to lead us in the Pledge of
I
Allegiance.
think it's the first time I've ever been asked to lead it.
Oh.
No, only once. Ready? Begin. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you very much, Chairman.
Welcome. Okay, the Mendocino County Board of Retirement meeting for July 15th, 2026 is called to order at 8:35. First item here is public comment on matters not on the agenda, and I'm betting there is none.
There is none.
Okay, thank you. And that brings us to item number 1, the consent agenda. And all matters on the consent agenda are to be approved by one action without discussion unless a board member requests separate action on a specific item. Does anybody want to pull an item for discussion? No. Okay, that is gonna, the consent agenda is approved by unanimous consent. Brings us to item number 2, investment actions. And item A on number 2 is Artisan Sustainable Emerging Markets Performance Update. And I
Thank you,
believe-
Chair Land. Mr. Revelis just went to get the artisan, and they'll have a presentation for us here momentarily. Good morning. Good morning. How are you?
How are you?
Good morning.
Welcome.
For you, if you'd like.
Yeah, that'd be great. Nice to see you.
Sir. Hard copy for you.
Thank you.
I'll run it on
Save one for
the
Vince.
screen.
Always
One for
Save one
Vince,
for
huh?
Vince.
He's the one who always wants
beautiful.
the hard
Yes.
copy, but he's not here.
Nice
today.
nice time of year. I'm sure.
Oh, I got you. I'm good.
Unless it's different, I mean,
Okay, you okay?
No.
the presentation we have.
All right.
Nice copies. Great,
Thank you.
Mm-hmm.
Let me share screen.
Up it is. Not seeing how larger here.
The-
The little next to the X thing.
Yeah, they'll do it.
Yeah.
Oh,
Well, he
oh, right
has
here.
to-
There,
he-
gotcha.
Okay.
Perfect.
I'm just
Better.
playing around with the view. There you go.
Okay.
Great. Well, thanks everyone for having us. It's great to be here, and we're thrilled to be here with you all officially being a client of ours. We really appreciate your support. And joined today, you probably recall Maria Negrete Grusin. So Maria is the lead and founding portfolio manager of this strategy. And my name's Sean McCoy, and I work with all the clients and consultants on this strategy. So we want to just give you some quick updates. You've been with us just over a year now. Robert, if we start on page 14, just highlight a couple of the numbers. Perfect. So as I said, basically funded at the end of May 2025. Total assets today are close to about 32 million. Had a redemption in September of last year, taking about 3 million off the table, which I think is great. EM as an asset class has done quite well. So the index is up over 46% since inception. Over the last year, it's about 43%, and we're in sort of the mid 20s over the year to date, quarter to date this year. We have underperformed in that time period. We'll spend a lot of time talking about that today. What we've really seen is while there's been a lot of interest in the asset class, the index has continued to get extremely concentrated. So one of the key points really is not owning Samsung Electronics. So that's the second largest name in the index. It's about 8% of the index today. And we'll spend time discussing that, but we've made the decision before you funded to move from Samsung Electronics to SK Hynix. Two very similar Korean companies. When I look at the numbers, Samsung has actually underperformed SK Hynix very significantly over all time periods. So since we first bought it from the inception of your portfolio, 2025, Q2 year to date, owning SK has been the right decision side by side, but given Samsung is so big in the index, not owning that has been a very enormous headwind. If we take Samsung out of the index, we would have outperformed, but obviously we didn't. It's a big name in the index. So we'll spend some time talking about that. As I'm sure you hear from a lot of managers right now, a lot of these indices are very concentrated. So in the EM index, while there's over 1,000 names in the index, the top 10 make up over 40% of the index, and only about 30 names make up half of the index. So when we think about that concentration, over 50% of the index is in tech, just across the board. So that's a high concentration there. It's much more significant than even a couple years ago. But over 90% of the return in the year to date has come from that sector. So it's the biggest sector, it's half the index, but over 90% of the index return is coming from that sector. So we'll spend some time talking about that. Maybe I'll turn it over to Maria. We'll just quickly, Robert, if we just go back to page 2, I don't know if you want to just quickly touch on the team, and then we'll move into the attribution. We'll talk about positioning, outlook, and so forth today. And please do jump in with questions as we go.
Perfect. Thank you for having me here and the opportunity. So I was here just before talking about these things, just a quick refresher of who we are and how we do what we do. The team has a long history doing emerging markets. We have been together in Artisan since 2006, but the team preceded that. We started doing this in the late 90s back at DuPont Capital Management. So the history of the team is almost the history of emerging markets. Our experience comes from having been invested in emerging markets since they first became investable, many of them. So we have seen this sort of up and downs of the asset class. So this continuity of team and process is something that we believe we bring to the table. We have learned many lessons during this period. Not every period has been good to us, but we have incorporated these lessons learned in the tools we use today, in how we pick stocks, how we approach the market. And the final point about sort of the team is communication. It is a team that you can see small, and we like to keep it small because that is what allows it to be a true team. Nothing gets lost in translation, meaning that we are meeting 4 times a week, communicating, like seeing what's happening and acting on, being nimble, being agile. The idea is not to have an opinion in every stock out there, is to have experience and criteria opinion on the 60 stocks that I'm making in the portfolio. So I will start with that, and I sort of lean on the experience point because I think it's very important in a time period like what we're going through right now. And maybe we move on quickly into, I won't talk too much about the process, but just to simplify on page 5, if you can go there, our process is looking philosophically for stocks that have unique access to growth or sustainable competitive advantage. Which of those are undervalued relative to the sustainable earnings? So we spend a lot of time really getting deep into this company, the earning power, how the company makes the money. So these we go income statement, balance sheet, cash flow, really looking at sort of the history, and then we do a 5-year forecast. So what matters to us is not how amazing this company is doing today. What matters is can they translate this into sustainable growth and sustainable earnings. There is a lot of what I call one-day flowers of emerging market. One right place, right time, and you do amazing, and the whole thing crumbles because circumstances change the market, the industry. So it's very important to us in all this financial analysis we do is going for what is the true sustainable earnings that these companies have. After we commit to that, let's say this is what we believe is the earning power, we're looking at what is the appropriate valuation. So valuation matters to us in the context of emerging markets. Again, it's not about trying to pay anything for what is in fashion today or what people like. No, It has to be a discipline of earning power, has to have appropriate multiple, and that is what we're looking for. So all we do in country risk assessment and sort of industry analysis is to assess that is what is the appropriate multiple. So in this context of earning powers being sort of the basis and the appropriate valuation is what we apply to every name in the portfolio. So when we look at, skipping a little bit forward for the purpose of today, to positioning slide on page 13. The current position of the portfolio is the product of these stock selection decisions that we make. So we are starting looking at this slide from the top left. In terms of capitalization, we are indifferent. If a stock is large, like let's call it TSMC, which is a very large name, if we believe it has upside, it belongs in a portfolio, right? So we are not trying to pick stocks for size, so this is big or small, no. It's typically we will find ourselves overweight on that mid category. We believe some of the new stories in emerging markets belong to that category. In terms of industry, on the bottom and the top right, we, again, not thematic. We're not saying we like financials or we like technology. No, we like stocks that have that combination of earning power and valuation, and that is what they get selected. At this point, you can see, and I'm going to go deeper into what Sean was talking about, emerging markets has gone to a massive period of concentration. It's historically, I think in many years and decades that I have doing this, I've never seen this degree of concentration because it's not even sectorially. It's 3 names, 3 stocks are concentrating the index. I think you all are familiar with what's happening in the US with the fabulous, well, multiply that by 100, and that's what's happening in the end. It's even deeper concentration. So on the country, on the bottom part of the slide, our country allocation is fully consequence of our stock selection. Here, though, we make a deliberate effort to find true emerging market exposure, right? We believe EM exposure exists beyond sort of the confinements of Asia. We believe other parts of the emerging markets offer these opportunities, and the point of kind of really finding these true diversified opportunities, these distinct opportunities, authentic EM opportunities, that is where we're trying to look here. And on the pie chart on the bottom right is something that I emphasized a lot the last time I saw you, is about 40% of our names are not in the index. So I guess when we look at the degree of extra concentration, top-heavy, centric that the index is, we're seeing our view of emerging markets is that is not a representation of the investment opportunity. You have to go beyond that to identify the true investment opportunity, and that is what we do, right? So when we look at the point that Sean was alluding to in the previous page, the index concentration. And I think when we talk about sort of the year-to-date performance for us and the source of the performance is all can be sort of summarized about this. As you can see in the chart on the left part of the chart, yes, the index is very concentrated. And I think this has a lot to do with the thematic of the day, which is AI. AI is driving it, and we are believers on an AI future. What we disagree, perhaps, is with the fact that there are only 3 stocks that represent the AI future, which is what the index is implying. We believe AI is going to change our lives, and we welcome the investment opportunities that this brings. But the idea that the only way to express it is through memory names. As you know, the AI story is like memory and sort of hardware is a way that is required for the computing capacity that is required for sort of teaching the robot, or like really going forward in a more simplistic way. So when we look at the memory names in emerging markets, these are names that we are extremely familiar with. We have known Samsung Electronics and Hynix since the beginning of my career, since they were very simple stocks that really nobody wanted. We have been owning, frankly, all these names, and including Samsung. We own Samsung continuously for decades. Samsung is a company that is specialized on memory and DRAM, and it has sort of grown to that. It has other derivatives to the business, telephony, as you can know.
Question?
Could you contrast the main products that are the engines for SK Hynix versus Samsung?
Yeah, there are 2 of them. Samsung is a more diversified company, right? DRAM is the center of this, But Samsung also has these other businesses, which are the electronics that we see in the house, all that, and together with that, it has telephony. So when we look at the part in which they intersect, is in DRAM. The difference between Samsung and Hynix is more specialized, a memory name, DRAM, but it has the more high-end part of memory. There is something called HBM, which is like a sort of the next generation of memory. That is more required for the large data centers, for the scale, what the mega scalers require. In this, Samsung also participates in this market, but certainly Hynix has the leadership. So when we make the distinction between owning one and the other, is we want to own the company that really has the leadership, that has the leadership in the technology. At this point, with the moment in which we are in AI and the enthusiasm for AI, the market has decided that you have to grab in both directions. And what has happened, the scarcity of memory, which is the moment that we're doing, has created an increase in pricing for sort of memory for both of them. So certainly Hynix is benefiting, as Sean said, is the stock that has performed better. But Samsung, a company that really in our mind in technology is lagging, is benefiting as well, and it's kind of created this big tide that raises all, but both that raises all tides. Our view is that these companies are over-earning at this point, meaning that it's not that they are inventing something new. It's not that the DRAM that they're selling, that is a new generation on HBM. In the basic DRAM, which is what creating the stocks up, it's just price increasing. So that price increase is in our mind causing an over-earning that in our sustainable earning power analysis, we don't believe we need to pay for that. And that is the distinction we make. Yes, we believe in the AI future, and that's what we see. I come here and defend TSMC, which is, as I think we spoke about the last time about the stock, TSMC is an exceptional name. There is not a memory name. They are in the higher end of logic chips. There is no NVIDIA without TSMC. They are producing memory, what Samsung, all you need is money and time. And there are going to be a lot of memory being produced. And there are going to be Chinese companies and other companies around the world because this scarcity is costing all of us money, right? All our electronics are going to cost a lot of money if we keep increasing the price of DRAM. But TSMC is in a different league, I would consider, versus Samsung and Hynix are playing in the commodity space. On that commodity space, we argue that Samsung is further commoditized down versus Hynix, which is differentiated. In our construction of the portfolio, we don't see the need to own them both. In a way, the hurt that we experience here today is because we don't own them both. If we had to, because these stocks have, and you can see on the top right, the contribution to the year-to-date returns is 90% contribution from them. So not owning one of them, it's not that you can own the best, amazing financial or any other name in emerging markets. No, it had to be Samsung and Hynix. We own Hynix, we own TSMC, we believe in these names. We don't think our job really is to kind of imitate the index and own them both, even the inferior company, because at this point that concentration is what's driving. So I think that I make the point of the concentration in the context of history. We have seen periods of concentrations in emerging markets before that ultimately end up in tears. This is previous to our relationship, but I remember when China was everything, and everybody said, oh, China's going to be bigger. Well, what happened with that? Eventually, it derated, and China now is the number 3 country in the index. And I think Sean created some, in terms of the degree of concentration and the history, how it has evolved, the concentration.
Yeah. So 2010, the top 10 names were 18% of the index. China was 17%. If you go to the end of year 2025, top 10 in the index is 33%, so a third of the index. China was 25, and then just moving ahead 2 quarters to end of June, now we have the top 10 at 40%, and China has dropped down to 19% of the index. And as you know, the index has a lot of names. There's over 500 names in China, while Taiwan has really moved up to the top country now with only 72 names. So as you can see on the chart here, just looking on the bottom of the page, those largest index weights by holding on the bottom left, you see TSMC quite large, Samsung second largest, but we have just a huge concentration towards those top 3 names and what they've delivered is on that bottom right, as Maria described. So all three of those names are basically a quarter of the return we've seen in the year to date. And just putting the numbers side by side on SK and Samsung. So in 2025, SK Hynix returned over 280%. Samsung returned 130%. Both great returns, but the market is rewarding a lot of what Maria is describing, with SK being the leader. Year to date, SK Hynix has delivered a 279% return, and Samsung's delivered 155%.
But
Again,
just to stop to these numbers, right?
Yeah.
These are stocks delivering returns in the 200+%. I think that is what we kind of take a pause and say, let's look at the sustainability of this, which is our process. Let's look at this sort of notion that memory and, like in general, this AI will raise up. That is something that we take a pause.
Where are we in terms of generation for memory? Are we at the tail end of one generation and beginning of another, or where?
We are HBM, which is the next generation. We are 3, there are 4. Hynix is at the highest end of that. I would say there's still memory is required for many things. I think the next generation is required for really the high computing, the data centers. On that, we are kind of changing at this point, and Hynix is leading that change. So we are, again, believers on this future. The issue is to assume that there is this scarcity on the more commodity part, on lagging generation of memory, is going to perpetuate this increase in pricing. That is what we disagree with. So in that sense, we say, well, let's continue to look at broad opportunities in emerging markets, even in AI. So there is no AI without power. So let's try to find power, or where the energy for this is coming from. In our portfolio, we have 2 names that are related to nuclear power, which is a very important part. We have a name in Kazakhstan, Kazatomprom, which is the number 1 producer of uranium in the world. Uranium is going to become more demanded, as we know that to feed the energy that is required for this data center is required to have power. We have Doosan Energyability in Korea, another name that is they make nuclear reactors. So is this notion that the only way to express this future is to these 3 names? No, there are many other names in emerging markets that we can participate on. Well, those names are not closely performing the way that the memory names are performing, but in our mind, we can be patient about this. When I come here and say, oh, yes, we have lag in the year to date because we haven't owned one of the names that is sort of in that concentrated top, but we have owned many other names that we believe are, although lagging, they're very good expressions of that future in AI. It's not about that we don't believe in no. It's no believe or no believe. It's in front of us. What's happening is there are more than one ways in which emerging market stocks we can express this opportunity. And I think that is what we have always done in our portfolio, create opportunities broadly in emerging markets. This idea that we need to mimic the index, which would have been really the only way to outperform here today, is to own these 3 names. You miss one, and you miss ESNC, and really you're nowhere. But if you miss one, you are in a lot of trouble, right? I think that we will take the pain, let's say, short term, because we believe there are many other great opportunities in emerging markets today, are more discounted valuation. Because I think this over-earning that these names have, the market is expecting you to pay this higher multiple for earnings that we don't believe are sustainable. Because these earnings are not dependent, these companies are not spending more, they are just earning more from the same, pricing more. Prices are increasing 60%, very increasing. Ultimately, we believe that will cause demand destruction or competition. And I think both things are coming up. Demand destruction in one end, people saying, wait a minute, Apple, all the companies that are buyers of this saying, wait a minute. And on the other end, the competition, which is being built capacity in other places. So I think that moment in time, which is a very exaggerated in terms of performance moment in time, we try not to think of that as this is the only and the permanent situation. There are others, and we have seen these sort of extremes in emerging markets over time, and we continue to believe that our job is create a portfolio that expresses the best opportunities with the most upside, not to try to chase sort of this index concentration. But
yeah, I was going to say, maybe if we just flip to sorry, go ahead, Rob.
So I guess, Can you maybe talk about or mention what would have to change from Samsung, kind of for you to reevaluate your position?
Yeah, I think there are two things that are, I think what's happening, and in that case, it's about Samsung and about the industry. Samsung will have to demonstrate that they can regain the leadership on the next generation of memory. The question of that has to be demonstrated, and it's not. I think that Hynix certainly has the leadership, the new generation of memory. That's very important to us because, again, it's not about owning all the names that are exposed to it. It's owning the names that are exposed to sort of the leadership of that. So that is something that is very important. The second thing about Samsung is a matter of governance. Samsung has always been very deficient in a matter of governance. I think small steps have been starting to take place. I mean, the massive degree of cash accumulation. I don't know if this doesn't tell you what is this is an extreme situation. They had to pay every employee in Samsung go to $500,000 this year, trying to utilize, and they're going to cancel some shares related to that. That is sort of almost the extreme of accumulation that has taken place. I mean, every employee means your job is to, I don't know, real estate in Korea around Samsung plants going crazy because everybody just got that.
Well, and that's a good point. Can you maybe talk about that more? Some of the governance issues, I guess, within Korea that you know that Samsung's trying to deal with.
Samsung and all of Korea, they have this, I mean, history and legacy of bad corporate governance, accumulation of cash, family ownership, and chaebols, this sort of intermingling corporate that is very untransparent to minorities. This is a long history. Companies in our mind, like Hynix, has been able to detangle this and move forward. In the case of Samsung, they are lagging behind. Korea has an initiative, it's called Value Up, which is really the Korean government almost pushing their companies to be more shareholder friendly, more return friendly. I would say Samsung is the laggard on that respect, but they're moving in that direction. I think that it's obviously easier to move in that direction when you have such a massive excess of accumulation because of the pricing power that they have at this point. But in that doesn't take away from the fact that Samsung is really a lagging company in matters of corporate governance, the distribution of the cash, the transparency. Even today, the transparency of disclosure, we cannot even tell with clarity in terms of breaking out the earnings from the more legacy to the more leading. All these are things in which transparency, which are things that are important to us, matter. So I'll put one in the requirement, the leadership in technology. The second one is the going more first class or world class in terms of governance, which is something that Samsung, even in the context of Korea, which is not the best, is lagging, in our opinion. So those two things, obviously, at this point, also has to do with the industry. The industry, and I think that is our biggest concern at this point, this sort of excess earning of the industry will determine whether we want to participate on Samsung or Hynix or either one of them.
And following up on these big three, do you have any thoughts about the ADR recently with SK Hynix? Can you maybe
people ask me that all the time.
Tell us a little bit about that.
No, it's part of this moment in which we are, in which U.S. investors and global investors are very euphoric, let's say, about the memory names and the way to own memory names. There are other ways to own technology, and U.S. obviously has some of that, but in the memory names, accessing the Korean names has been a lot of PR and products related to that. So Hynix taking advantage of opportunity and diversify the investor base has created a stock for that. I think that is almost a natural progression. There is just access into the market. There is a lot of interest on the market in memory names, and Hynix really being the better of the memory names certainly is appealing. The volatility is maximum though. I think the stock is up 26% today, something, but it was down yesterday. I cannot. It's quite extreme in volatility, and that is something that, again, we're trying to look beyond this short-term volatility on the one who has the leading technology, who has the upside in valuation, and moving forward, rather than than trying to kind of catch the moment. And I think, as we have seen, we own these names for decades. We own these names for a very, very long time.
Where do you see the nearest competitor to Hynix of the lesser companies?
Is Hynix, the competitor is Samsung, which is still the lesser company. And in terms of memory names, there are a couple of Chinese that are trying to get into the game. They are more in the commodity space, big orders. So that is China is the nearest competitor. And China will do to memory, to DRAM, what China does to everything. Massify it, chipify it. So when we get there, there will be a different game. But there are some barriers to entry to this, and it's not only capital. What it requires to maybe the most commodity part is capital will get you there, but there are other characteristics in terms of yielding and sort of technology improvements. They're moving very fast, and there is certainly a gap between the Koreans and the Chinese.
And then could I go back to a concept that you mentioned, uranium and data centers? I thought also plutonium was also used. So could you?
We don't have that access to that in the context of the emerging market or their portfolio. I think that is what we're trying to look. What are sources of energy that are kind of compatible with this next generation? And I think we found Doosan Energibility, which is how they make a nuclear elements for nuclear reactors. This is an industry that was abandoned after the disaster in Japan. A lot of people started disinvesting, including the US, on nuclear. Only China really was investing in nuclear. And Korea, a couple of the industrial Koreans, including Doosan, continue to. And I think, remember when Germany walked away from nuclear and it was all like nuclear is bad. I think that the next generation of nuclear, which is where we are right now in terms of safety and in terms of efficiency, if we are really serious about clean energy, we need to be serious about nuclear. The US, the rest of the world is. And that takes us to the point of the data centers, right? These small nuclear reactors is the future of how not these mega reactors, which is what we're using, the small ones, need to be fed. And I think that is what we're running. Actually, I was in Kazakhstan. I went to see them. I have a picture of me next to my husband is that a good idea to be hugging uranium? I mean, it was empty, obviously. It's there like for show. They're not. But anyway, this company just doesn't enrich. It's just basic. It's a mining operation. Very concentrated, very close to the demand centers, the US. I think that sort of awakening in Europe, in Asia, and in North America to part of a sustainable energy matrix for the world, clean, sustainable, needs to include uranium, needs to include nuclear. Where do we source these? And we find that aside from Russia, which we know is sanctioned and not investable, Kazakhstan has the #1 resource. And I think that is where we find I think that we go into plutonium, into rare earths, and this is something that from our materials point of view, we continue to be interested in looking and finding opportunities there. But I think they're more clear to us at this point. Certainly, there's copper is part of the future of energy. We own a name in copper as well, Antofagasta. So that's my point. Is there are many other ways to participate in emerging markets in this future of energy, and I think the whole electricity infrastructure globally, especially in the US and in many, needs to be upgraded. And I think there are many companies that are part of this upgrade, not nuclear, but just in general, the energy grid.
When is China no longer considered an emerging market?
I think that is a question we contend for always, right? I think in many ways China is a very developed market. So you would say about Korea and Taiwan in many respects. But in China specifically, there are other parts of China that are very emerging. And I think that is almost the challenge, right? It's not to simplify these markets, to say, oh, they look like developed in all these things. There are other aspects of them in which they still have these EM characteristics, meaning low penetration. I was in China recently, earlier this summer, and I went obviously to Shanghai and to see companies, technology, all that, which are the China that is the future, right? But I took a time with one of our analysts is from Chinese, so we went to Wheeling. Wheeling is like you fly and fly another car for 2 hours and go into kind of inner China. That China, which now finally has basic infrastructure so you can get there. But that is a very different China. That's a China that requires staple products, that needs interconnectivity, that China also exists, right? So there are parts of China that are still in that emerging space, and they are very interesting, right? To sort of to simplify, to say, because some parts of the economy are there, is fully there. No, I think in the way we see it is there are parts of that that are still attractive from that penetration point of view and early emerging story point of view. There are other parts that are not interesting to us. So I think that is true of many parts, but China in particular, I think to see this other China, what I was so willing to go deeper, is so very interesting because it shows you go to Shanghai and it's better than New York. It's like you feel like behind, but this was maybe 5 hours in by flight. You find a very different place that is not part, because I've gone to many different parts of China. All the parts of China you see that industrial powers, where they make all the furniture, where they make all this. I mean, in these parts they don't make anything. These were formerly agricultural towns that now are happy that they have electricity and water. That is a lot of China still.
You mentioned Guilin and their limestone, beautiful formations. How much do you think they're going to really want just tourism versus development?
I think that's kind of their game at this point, is tourism. I think there is a new, call it, philosophy in China, which is called the lay flat. Lay flat is young people opting out from the rat race of, I don't want to go work at Foxconn, assembly iPhones, when the job is doing this all day and literally sleeping under the table. A lot of young people say, no, living in a dorm away. They say, I'm gonna go live near my village in Welling, which now has power and has a hospital and has electricity, and I can exist from owning a little restaurant or a little shop, and I live around my family. And this notion that all of the countryside of China has to migrate to the cities to be working on the assembly line, there is a lot of pushback on that. So these places like Wheeling, you can see a lot of like tours of retired people walking to the river and seeing these beautiful sites. And the businesses are like, it's called mom and pop businesses run by young people that in the past would have been working in the factories in the coastal area. That they have say, I don't need to make that money because here in Wheeling, I can pay, I live with my parents or in the house that used to be my parents, and with $100 I can exist very well for a month, and I can get that $100 from having something related to the tourism. That is a different model that China hasn't had, and it's a bit scary, I guess, to China, because the proposition is like you employ them and you keep them, and then now it's like, I don't want that. So the lay flat, that's what China is so opposed to the direct subsidy, because if they do direct subsidy, they will encourage more of that lay flat mentality of, I'm gonna go just chill in my village. And those are the type of village I want. And when you go there, you realize the standard of living is so much better. It doesn't have the flash and the greatness of the big cities, but many people, you don't need that, right? You need like a hospital, a good place to live, and an opportunity to create your own business. And tourism offers that opportunity. So places like Wheeling, for sure, very well positioned. And I was the only non-Chinese tourist in that town. It was all Chinese tourists. It's not designed for the international world. It's designed tourism for their local people. A lot of retirees traveling, a lot of some young people, and a lot of young people holding the businesses and managing the businesses there. New hotels, new activity in a kind of different economic engine than the traditional China economic engine, which is employment through manufacturing.
Is China still suppressing youth unemployment statistics?
I'm sure, yeah, because it's extreme. And this laid flat mentality is making it more because some of them is not by, they couldn't find a job, they graduated, they couldn't find a job, and rather than stay there, they went back to the villages. That was not a possibility even 10 years ago. These villages were not really livable in terms of infrastructure, basic services. Now they are. So now that option, because China has spent so much in infrastructure over the last decades, that now that is an option. And it creates perhaps a less powerful economic dynamic thing for the country, but a good option for the youth.
So we've heard about the index concentration happening. Can we, in the last few minutes here, step through the actual portfolio? So I flip forward to
Yeah.
18. Maybe we'll just go through a few more slides.
Yeah, for sure.
see
And I
that.
think 18 is good. It just gives you sort of a view from a country level. So I think one of the things we really want to leave you with today is we are obviously stock pickers, we're active managers. We want to look different from the index. Yes, we want to own large index names if we believe in them, but as you look through this list,
Maybe page 28 is even better.
okay, yep,
If we
individual
can go
names.
to page 28, that is actually the composition of the portfolio. And as always, in terms of what do we own, I think you will find places, A, with Argentina. You know, Argentina, which has been a very marginal country in many ways, we found 3 names there that are really very world-class and representatives of the type of opportunities we look at there. And then we keep going down the list, and you find names like Georgia, for example, or Greece. These are countries that might be off the beaten path in many ways, but they're very representative of great opportunities. I was in Greece recently and meeting with Alpha Bank, which is one of our names there. I think the best story of a bank in Europe. I mean, they came from that Greek disaster of a crisis. And if you go to Greece today, I would say that's one great example of a country that it did emerge. That is not a partner. Greece, and it's going to be moved to developed markets, rightly. So I miss it, but that is a good story in terms of coming from a crisis that was all destruction to this financial institution, 4 banks, which we own one of them, but the 4 of them kind of going through the rubble of that and creating great opportunities. So Greece is another example, and if you keep going in that list, you'll find names like Panama, for example, is another example of a name that is not even in the index, but Copa, the airline we own there, is very representative of a great, rare airline that is great, which is not often, that is really very well positioned in this connectivity space. And I think when we look at the final list, the final in the list is Vietnam. Another part of the world I would like to highlight is one of the winners of this sort of new deglobalization or whatever, the new rates, trade routes that are emerging in the world, right? When this conflict between China and the US is sort of a permanent conflict, when the situation in the Strait of Hormuz have taught us that the world is further disconnected. Very unfortunately, I guess, this war that we find ourselves in, but these are realities. So I think the alternative routes, alternative sources of energy, nuclear versus Hormuz, or segmented routes of trade, Vietnam versus all coming from China. All these are true kind of opportunities in emerging markets today. And we believe that that is in the portfolio. So I don't like to come here and just talk to you about TSMC and Samsung. We have to do that today because they affect on performance. But what we're excited about the portfolio is pretty much everything else.
Where do you see the Baltic states, if at all?
Those are not EME, the northern ones. They're interesting, and I think I would say Ukraine and the resolution of the Ukraine war, which I guess I live in hope that this will happen for humanity's sake, will create a very interesting dynamic here. I would think the Balkans and the Baltics. In the Balkans, we are exposed to, we have a bank in Slovenia, and I think that is very interesting, and Megan recently went to Serbia. But if you go further north to the Baltics, Latvia, those are more developed type countries, but with the new reality that Ukraine will present us, there will be plenty of opportunities really there. The reconstruction in Ukraine, the increase in defense spending, an ugly reality, but it's a reality. It will create opportunities of investment. I think defense spending has been neglected in the past by Europe and many parts, and that one of our names in our portfolio is Aselsan, which is a technology defense company, which they specialize in the domes and the protecting the civilian population. That is something that the realities of these two wars put in front of us. It's not good, but it is reality. So I think that the resolution of the Ukraine war in whatever way it is, whether Ukraine is reconstructed or Ukraine becomes a defense buffer for Europe, both ways represent some actions of investment.
Thank you.
Okay, are there any further questions?
Almost at 45.
Okay. Any final thoughts?
Yeah, I would just say, sort of as Maria was closing with, what's distinct about this portfolio are the off-benchmark names, the sort of differentiated areas of EM. We want to really provide you with what we think is the authentic, sort of true EM opportunity set. So, as I was saying earlier, yes, we'll own some of the large benchmark names when there's an attractive story there, the sustainable earnings are there, the valuation is there. But a lot of what really has driven our alpha historically over time are these off-benchmark names. So a bank in Vietnam, a bank in Slovenia, the Greek story. So a lot of that's where we can really look different from the index and peers. And we're at a point right now where this concentration is really focused on the really big names. But what you should expect from us going forward is stock selection. And that area that's more differentiated off benchmark is really where we tend to do best over time. So we're in a sort of 1 year window right now where it's been a big index heavyweight story, but in a full market cycle, we would expect some of those names Maria was just talking about that you probably don't hear about as much to be the drivers of performance going forward. But those are the main points. Really appreciate your support and look forward to seeing you guys again soon. Hope you have a great rest of your summer.
Thank you very much.
Yeah, thanks everyone.
you.
Good to see you. Good to see you.
Very interesting.
Thank you.
Thanks for that.
Thank you so much. Thanks for having us.
Can we ask Callan to drive their own presentation?
Yeah, sure, we can get that.
Thank you.
They can drive.
Thanks everyone.
Thank you.
Take care. It was really good.
Very interesting.
Good morning.
Good morning, everybody.
Good morning. Okay, that brings us to item B.
We have 4 Callan people. How exciting.
Yes.
We do. That is item B, direct investment considerations. Greg DeForest, Claire Tolene, and Hannah, and someone else.
Ashley Kahn.
Ashley Kahn. Welcome.
Great. And did I hear, do you want us to share screen? Okay. Yep, I can get that going. Give me 1 second here. Okay. Can you see my screen? Can you see the presentation? All right. Perfect. Well, good morning. Great to see you all. Thanks for having us again. So today's discussion is our second in our series of educational discussions that we've mapped out for the fiscal year here. So as you know, we were with you in June talking about asset allocation by function. And today we'll be talking about closed-end and direct investing considerations. So really talking about private equity and private credit more specifically. Similar to last month, the last educational discussion, our goal is to, target maybe 20, 30 minutes for this discussion. So again, just kind of a bite-sized educational review, no decisions required, but really looking forward to your questions and engagement throughout here. So I mentioned, again, the focus today is closed-end and direct investing considerations. I do want to note, though, that in October and December, we have 2 additional discussions on private equity in October, and then December we'll look at private credit education. So today's discussion is kind of an introduction to those two future discussions, with the key focus today being, how do you invest in private equity and private credit? The investment structure and the vehicles for those investments are different than, say, your public equity investing or investments that you hold in the portfolio today. So that's what we're going to talk about. We really want to go through kind of the details of that and considerations for the different types of approaches to gaining exposure to private equity or private credit in the portfolio. As was already pointed out today, there's 4 of us on the line from Callan. So Greg, Hannah, and I are here, and we're joined by Ashley Kahn. Ashley is the head of private equity research in Callan's alternative consulting practice, and importantly, one of the many subject matter experts at Callan that support all the work that we all do together. So Ashley's going to do the majority of the talking today, so I'll hand it to her here in just a second. But the one thing I want to note before I do is that in the appendix of the presentation today, we did include some peer group information. So looking at other SERL plans, focusing on the plans that have $1 to $10 billion in total assets, and how they approach private equity investing in their portfolio if they have an allocation. So that's in the appendix. We're happy to touch on that, but just wanted to note that it is there. And we'll bring it back as we have that kind of more focused private equity discussion in October as well. The key takeaway from that, though, is when you look at that peer group of plans with $1 to $10 billion in total assets, plans with less than $5 billion tend to use a fund-of-fund approach. So we'll talk more about what that means in a second. And as plans get larger, so the plans with more than $5 billion, they're more likely to use direct investing, have kind of dedicated investment staff, an internal CIO, kind of a more complex governance structure, if you will, to support that type of investment. So that's what's there. Again, we can look at it again in the end, but just wanted to note that it's there before we dive into the presentation. Any questions on the goals today? Okay. Awesome. Then I'll hand it to Ashley to jump in, and I'll drive the slides.
Great. Nice to meet you all, and thank you for having me. I'm actually sitting right next to Greg. You just can't tell. So we thought we'd start with just a refresher on what are these asset classes and why would you do them in the first place. So private equity and private credit are private unlisted investments in either the equity or debt of companies, and you're typically accessing those through limited partnerships. So, they do provide some diversification within sort of an existing portfolio of public securities. It's a different opportunity set. The primary appeal is performance, particularly for private equity. That's why you would do it, is for the return. You can see that reflected in our capital markets assumptions here, which is just a risk return graph. So private equity, the top and to the right. And then private credit, again, you're looking for outperformance compared to high yield. Here we have it modeled as 125 basis points above high yield, but at a similar risk level to US equity. So that's kind of where the two asset classes sit compared to others. But at the same time, yes, you want to outperform, but it comes with some drawbacks. These asset classes are more liquid, they're highly complex, and there's a wide dispersion of returns between individual funds. So multiple considerations to think about when you invest in private markets.
Slide, private credit is kind of right next to US equity. And so kind of tying it back to asset allocation discussion that we had last month, the private credit a lot of times is considered in that growth bucket, which kind of makes sense if you're looking at it from this perspective. It's close to equity right there.
Which one of the two categories, or maybe both, did some of the pension systems in Oregon run afoul at?
In Oregon. Oh, great.
In real quick, Ashley, I had this kind of had come up, Trustee Swope, before where you had asked that about Oregon. I had a little bit of trouble finding the specific incident or whatever stories you're remembering, which is why I never really followed it back up with the board. I can only assume that what you're thinking about is when rates went up in 22, everybody that had private equity, those values didn't change with the market pricing that the public markets experience. And so, you know, that's probably what you're thinking. They had this denominator effect where they went above allocation, and then they had to write down those assets to try to sell them on the secondary market. I think that's what you're recalling, but I was never able to actually find that
see what I can
specific. But it wasn't just Oregon. I mean, that happened all over the place. Even our own portfolio experienced similar types of market reaction, right? Where we verged, and we had a memo a few years ago related to that. Yeah.
Doris, you had said you pulled it up. Or...
I did a quick search, and I basically found some sources that indicate that Robert's understanding is correct, that it had to do with a heavy allocation to private equities that were very expensive as far as the fee load, and then also wound up underperforming. I don't know the exact year that this was talking about, but there is some information out there on it. It appears to align with what Robert just said.
Okay, thank you.
Great. So flipping ahead to the next slide. So really getting into kind of the meat of how you would go about implementing a private markets programs. You can think about it in terms of 4 different pillars. So we would start with program design, which is in the upper left on this slide here. So really thinking through the appropriate governance structure, staffing needs and resources, taking those into consideration and determining the appropriate implementation model, defining return objectives and risk parameters, and then kind of culminating that together into an investment policy statement for the asset classes. Would then move into more of a strategic planning phase. So looking at what you want the portfolio to look like. So we run commitment pacing models, typically on an annual basis for clients. So we would start by figuring out the appropriate commitment budget, look at what types of strategies or geographies you would want included, the type of vehicle, and then what type of liquidity would be necessary. Once sort of those sort of plans and procedures are in place, then we get into more of the ongoing maintenance of the program. So manager selection, due diligence, figuring out kind of terms and conditions, and then on an ongoing basis to kind of finish it off with monitoring, figuring out the appropriate benchmark performance measurement. So again, the sort of a flywheel, the two all kind of go together, but these are the 4 building blocks that are necessary for a long-term successful private markets program. And so here, just want to give kind of a diagram of what these partnerships look like. So it's a little bit different. Private equity and private credit are accessed through a limited partnership vehicle. So the manager is referred to as the general partner or GP. The investor yourselves would be the limited partner or LP. And so you'd be investing in a fund, which would then invest in portfolio companies. So there's a little bit of a different lingo with the asset classes that just takes a little bit of getting used to. So private equity, you can either implement through a direct portfolio, so you're investing directly into individual funds, or through a fund of funds approach. Both of these would be closed end in nature, meaning you make a commitment up front, and then that commitment is invested over a number of years. The next slide will show a nice illustration of that. Private credit, on the other hand, is a little more flexible. There are open-end structures available, so those would look maybe more like a core real estate fund or an open-end infrastructure fund, or there are also closed-end structures for certain types of private credit strategies.
Those companies, and we just.
Yes.
Or the limited partner buys into that whole plan.
Exactly. They're blind pool vehicles for the most part, meaning you don't know what's in the fund before you make an investment. That may be a little bit different for an open-end kind of evergreen private credit vehicle, but for any closed-end structure, you're making a commitment without knowing what the underlying investments will ultimately be.
Basic structure is the same that we have with our real estate and infrastructure managers, where we're limited partners. The general partner, JP Morgan, is running the fund, and JP Morgan makes portfolio company investments that we don't really have a whole lot of control over. In the case of an open-end fund, like Ashley mentions, we can see the assets they already have today. We don't know what assets they're going to buy tomorrow, right? They could sell some of those assets and buy new ones as the market changes. In these closed-end structures, they haven't raised any money, or they don't have any of those assets yet. So we would be relying on the GP, the manager, to actually, we're trusting that they're going to follow the process that they lay out to us, and that they're going to call that capital over a reasonable period of time. So that's the blind aspect that Ashley's referring to.
And the next slide, I think, would be helpful just to bring it to life a little bit more. So here's a sample closed-end fund. At the outset, you as the LP would be making a commitment to the fund. It's a legal obligation for you to fund future capital calls. The manager is typically making investments over 3 to 5 years. It can depend. Private credit's a little bit shorter, maybe more towards 3 years. Private equity takes a little bit longer. And so you would be receiving capital calls. It's generally 2 to 4 times a year to fund each for each of those partnerships. And then at the same time, the net asset value, or NAV, of the fund would grow, and you would start to receive distributions as investments are sold, or some sort of income may be collected. Private credit, you may see more regular distributions. Private equity, it's typically a longer timeline. They don't distribute until sort of those underlying companies are sold. So you can see here, this sample fund goes out to 15 years. Most private equity funds have a 10-year life, but they often go to 15 years. It's quite common. So it's a very long-term asset class. It's difficult to get out of. There is a secondary market. However, if any secondary transaction is typically sold at a discount, and so that may not be especially attractive. So it requires a long-term commitment from any organization in order to pursue these asset classes.
To even monitor private credit and private equity markets.
So we put together quarterly trends pieces. So we would certainly share those with you if you wanted to, move forward with the asset classes. The data for those comes from PitchBook, which is one of the main data providers for private markets, the other being Preqin. We also, I guess we do subscribe to Preqin for private credit, just not private equity. So that those providers kind of give us indications of where the market's been and where it might be going.
We lagged by at least 6 months So it's not the most current information. It could be that way.
Yes, yeah. So we're not getting into any of the reporting considerations today, but it is something important to keep in mind. There's at least a quarter delay with reporting for private markets, even longer if you do a fund of funds. So that can be impactful to your performance measurement report. Great. So we mentioned on the prior slide that these are long-term asset classes. They require a long-term commitment. The secondary market is not a great option, but it is there. And so this slide just shows the importance of making the right decisions from the start. There's a high level of dispersion in returns. This is just private equity on this page. Private credit looks somewhat similar, perhaps a bit narrower. So here, just looking maybe at buyouts in particular on the left, it's about 70 percentage points between the top manager and the bottom manager. And so it's very important to be above median in order to generate the returns that you would expect from private equity. So manager selection is especially critical in the asset class and can be very impactful to performance. We show public equity on the right-hand side just as a comparison. It's about maybe 7% between the top and bottom managers there.
This chart also speaks to me about the importance of having multiple managers, because you don't really know who's going to be the top and the bottom. Like we think we'll pick an above average manager, but it's really important to have a lot of line items if a winner and a loser is separated by 70%.
Mm-hmm. Yes.
And the number of line items is an important consideration when it's hard. It's there's more operational work to invest in a program like this, is in particular if you go direct.
Yes. Yes, it could be a long list of funds if you go to direct.
Chart with the risk and versus return, right?
Back on 2, I think.
Slide 3.
Right. So that's taking into consideration that variability in the manager returns?
No.
And the illiquidity associated with the asset classes.
These
it
are,
is a slight...
Sorry, Ashley, these are capital market assumptions, whereas the other slide is showing the dispersion of the returns. So they're to me, they're not saying exactly the same thing here, although they're related. This is really what's the capital market assumption over 10-year period here. The other slide is showing the dispersion of any given return. And actually what stands out to me on that other slide is the median returns are actually lower than the public markets on that slide, which goes more to the point, manager selection critical.
The way I interpreted Trustee Haschek's question is that the reason public equities is way over to the right at like 30% standard deviation
Private.
as far as that risk. Yeah, private equity way over on the right is in part because of the variation in managers gives you a more risk. And I think that was his question, and I don't know why is private equity so much more risky? It's not just the manager of your fund, it's the underlying investments in it.
Yeah, it's the process. You're buying out a company that you may or may not be able to managerially reform for a better sale.
The risk is represented more of the underlying assets being held, not specific manager risk. Okay.
I think all of that is correct. We if you observe a private equity program, the observed volatility may not be pushing 30%, but the implementation risk is so wide, we have a higher risk assumption for private equity to let people know, well, yeah, the implementation is much more variable, and that adjusts our capital market expectations and pushes private equity way to the right in terms of volatility.
A lot of other organizations have separate private equity consultants. Is that a contributing factor?
I think like if you're a really big investment program, you might want dedicated specialists in multiple areas to, there are a few large investors who have dedicated private equity, dedicated real estate, dedicated infrastructure, and a general consultant, but they tend to be, the multi-billion dollar, tens of billions of dollars plans. Plans closer to your size and maybe 3, 4, 5 times larger, a lot of them do stick to one provider, just the amount of work is a little bit less to justify the multiple service providers.
A plan was using fund of funds, they wouldn't have the same perhaps need for a specialist consultant because they're not doing direct investing.
Correct. And for Callan, we work with some plans and where we're the generalist and the specialist. We work with plans where we're the generalist only, and then we work with plans where we're the specialist only and do just direct private market underwritings and strategic planning.
Yeah, not all general consultants have strong private markets capabilities.
Yeah.
So
yeah,
that could be a factor. Right. So maybe just focusing in on private equity here, showing you the different implementation models. So on the left-hand side, you have a fund of funds. I'll just highlight maybe some of the differences here. It's more of a turnkey solution. You would have essentially one line item, one manager within your portfolio. You get a high level of diversification through that. The dispersion of returns amongst fund of funds is lower because they are so diversified. On the other hand, you're paying a double layer of fees. And so your net of fee returns could potentially be slightly lower as a result. On the right-hand side, the other end of the spectrum is a direct program. So here you would get a more custom portfolio based on sort of specific perhaps strategy preferences or geography preferences. The diversification level could be customized. So you'd have greater control over the portfolio. You'd not be paying that second layer of fees, so a potential for higher net of fee returns. However, the dispersion of returns is higher, and it's much more complex and more difficult administratively. And then some clients do some sort of hybrid program in between the two, where you have perhaps a core fund of funds and then add a few direct partnerships around that, sort of a core satellite approach. And there's different ways you could do that. But those are essentially the 3 ways to access private equity. So here's a nice visual, the 2 different models. Here's the fund of funds. So you would be making a commitment to a fund of funds who would then invest in underlying private equity funds. Those funds would then invest in the underlying portfolio companies. So it's a lot of layers, but the fund of funds manager does everything for you, all the legal, tax, reporting, audit, administration. You all would still have control over how much you would commit to the fund of funds every year. But you wouldn't have say over the underlying manager selection or portfolio construction. And then the next slide shows a direct program. So here you would still need some sort of professional management or professional advisor. So an investment consultant like Callan could certainly serve in that role, helping you select and diligence the underlying funds. But you all would be responsible for the administration of that portfolio. And instead of just one line item, it would be many. A typical mature private equity program can have upwards of 30 funds, sometimes 50, sometimes more if you're a really large plan. So it's a balance of, do you want control, slightly lower kind of headline fees with a direct portfolio, but you would have to manage all of that, the operational components.
So when the items on the right, the legal, so that's, Jeff reviewing the fund documents.
Yeah.
Anytime you make an investment, and like Ashley said, there could be, well over 10 in the portfolio. Tax, audit, fund administration, and then managing capital calls. So does that fall under fund administration or?
Yeah.
So that would be Robert, one of those 10 funds would call and say, hey, we've got a capital call. Can you send us $1 million by next Wednesday, or, 2 weeks from Wednesday, or whatever it is. So there's a little bit of administrative work that you would need to go into eyes wide open. Yeah. If we want to do these types of investments, it's a call on administrative time as well, unless you outsource it.
Earlier this year, there was pending legislation in California, if I'm articulating this correctly, that would have required public pension plans who invested in private equity to make certain disclosures, make more information public, that probably would have significantly impaired the plan's ability to continue with those investments. And I remember there was a discussion among the attorneys about this at a Sackers recently, and then the legislation got pulled. Are you aware of that? And is there a concern that that's going to come back in some fashion and could impact investments in this way?
Yeah, we followed that. I haven't heard any rumors of it coming back. It would certainly be a consideration if it were to. California public plans already have to disclose their private equity fees. We do that for other clients. And so that's perhaps an additional administrative consideration. You'd have to collect all the underlying fees. And it's a set template that you do every year.
To be really administratively burdened details in the sunshine rule or law that Jeff is referencing.
Mm-hmm.
Other questions?
Great. So here we just summarize a few of the key kind of decision considerations. So your governance, what type of decision-making body would be, overseeing the program that impacts the implementation approach, as well as the internal resources. Things like, cost and fees. If you're open to paying a double layer of fees with the funds or not, what type of diversification you're looking for, what type of risk, and the level of control. I'd say this slide's perhaps a little bit more for reference. It has a bit more detail on the 3 different implementation options. Happy to answer any questions, but just goes into a bit more detail of what we kind of just discussed. And then private credit. So wanted to spend a little bit of time on the different implementation options. There are private credit fund to funds. That is always an option, but it's perhaps less common and maybe not needed. Why pay the extra layer of fees if you don't have to? The main sort of options within private credit that most clients pursue are closed-end funds. So again, looks a little bit more like private equity. Your capital is locked up. There are also evergreen or open-end funds available as well. So you can enter and exit a bit more at will, usually every 3 to 6 months are the investor entry points. And then you can request redemptions. It's either quarterly or annually. It can take a number of years to actually receive those redemptions. So something to keep in mind, but in general, it's a bit more flexible. Great. So maybe just finishing up with a few key takeaways. We like to tell clients that private markets you have to want to do them. They're an organizational commitment. It's not just an investment decision. There's no best implementation model. It really depends on governance considerations, degree of control, operational capacity. And so those really are the factors that should influence your implementation choice. Regardless of what implementation route you do decide to do, you still need external expertise. So that's either a fund of funds manager or some kind of consultant or advisor. Relying on one of those really should set you up for long-term success. So with that, I'm happy to answer any other questions though. Maybe open it back up.
Please. Or staff.
Well, yeah, it just seems like for our portfolio that we wouldn't have that much money to really invest, like 30 million or whatever. If it was like a,
Well,
depending on the allocation.
yeah, and in the last asset liability study that Callan did in 2023, we didn't focus on the addition of private equity very closely, but there was an 8% allocation model. And so if we were to flip to page 17, just as a peer group, we could see that that's roughly the area that we would expect, 8%-ish. So, I mean, we're talking today, $60 million if we were going to do something like that, just as an example. So it is a fair amount of money, no doubt about that. I think Callan today would definitely recommend a fund of funds approach if we were going to think about that. I expect them to bring more detail on that back when we have the discussions in October. But yeah, I mean, the other question that we would discuss is where's it come from, right?
Right.
Because there's not that amount of money just laying around free.
We'd have to sell something else.
Right.
Yeah.
So you'd have to reallocate.
Yes.
Like,
Yes, Jerry.
I think I kind of led the discussion when we considered private equity initially. And the CalSTRS, but because of the size of the funds, CalSTRS had private equity opportunities coming to the board. It wasn't a matter of going out and looking for someone who's a general partner or funds, whatever. And I agree with you, John. I still do think that private equity, that we are not a big enough fund for private equity at this point, though we're certainly in a better shape than we were in the olden days when I came on the board. So, nothing has changed my mind on that yet, but I wouldn't be as opposed probably as I was back then.
It would seem like there's a lot of problems with the illiquidity of it as well. I mean, not that I understand, but you know, the length of redemption on some of this and all that I think would be concerning. Would have as much fat to absorb those kinds of delays in all of our assets, or even some of them. So
It would be built into Kellen Roberts' review of our liquidity needs, and we have a fairly liquid portfolio now because it's primarily in public markets, and we don't have any liquidity concerns because we can turn around and sell something quickly if we need to, you know, obtain $1 million for benefit payments. And I don't expect that to change really, even if you made a private credit or private equity allocation, but it adds more layer of review to ensure that we have appropriate liquidity, because the real estate is illiquid. Then you're adding in these items. Infrastructure is illiquid.
Right.
Private credit and private equities would be illiquid.
And I guess that would just put pressure on, you know, pressure to sell things that we might not otherwise want to sell in order to raise that capital.
You're always going to sell something from your public side. We don't keep like a dedicated allocation to cash because of the cash drag that's happened historically.
Yeah, I would say, you know, off the top of my head, we certainly could take on more illiquidity. Would we want to take on 8%? I'm not sure. 5%, like some of our peers have. I think that could have a minimal impact on liquidity.
Yeah, I guess Imperial's not scaled too far away from where we are, and they have a 5%. So, I mean, when you look at the other ones, they're doing 5, 8, 10% of a much bigger pile. 8% of 7 million.
Venture is down there at like 18 or something.
Is that obviously a lot more money than, or 5%, Kern County 5% of 7 billion.
You know, the other thing to consider looking at this slide, this is just private equity.
Correct.
Every other fund also has private real assets. So that would be like real estate,
Right.
something like infrastructure. It might be a
probably
commodity
private
fund. And there's also the private credit exposure.
So with this chart, there's orange and some of those bigger funds aren't listed. So is that because they're not doing private equity?
No, that's just, Callan can speak to this, but I assume it's because our comparison to them is much less relevant.
Well, it says up on top that pension plans with 1 to 10 billion in assets.
So
orange is
that's all we're looking at.
Yeah, orange is going to have more than 10 billion, I would assume.
This list is also the list that we're going to see in the cash flow report as well. Trustees may have noticed that.
So we don't have to make any decisions about private equity, let alone private credit today. But what we want to achieve with these educational snippets is just give you background and information for all of us to make a collective decision together when we do an asset liability study eventually, and when we consider which asset classes we should include in that asset liability study. And so one of the big questions was, well, if we did like the idea of private equity, how would we even do it? And so that's really the kind of the focus of today's discussion. And so we kind of illustrated the attractiveness of return, but there are governance and implementation and liquidity and all sorts of other issues. And as Claire alluded to, we'll go through and kind of knock those off when we talk specifically about private equity in a couple months and private credit as well in a couple months.
Laid out on slide 20 of the appendix where they talk about the guidelines and the policies, because this would be modifying our investment policy statement and other things, and also setting up certain processes.
Okay, are there any further
All right.
questions, or do we have more slides to go over, or have we completed? Okay, thank you very much. That ends item B.
Thank you, Callan.
Great. Well, so good to see you all. Thank you. And we'll see you in person in August, and we'll be covering the quarterly performance at that time.
Yeah.
Okay, so I
Bye.
think,
Have a great meeting.
Bye-bye.
Bye.
I think we're probably at about the halfway point for the length of this meeting. Is there an appetite for a break at this point?
Yes.
Yes, okay, so let's take 10, let's come back at 10:15, which is actually 12 minutes.
Okay, thank you for those 2 minutes.
Other system besides us that doesn't have any private equity?
Probably. Yeah, Jim Failer is 100% against it.
Yeah, I remember
Yeah, yeah.
back in the day.
I mean, I
Ready?
Yes.
Scott is ready, and we are being broadcast. So that brings us to item 2C, Collective Investment Trust, CIT update regarding PIMCO Total Return Strategy. Robert Revelis, Retirement Financial Investment Officer.
Trustees, you have the board memo where staff make the recommendation to essentially stay in the current mutual fund structure. I did my best to try to present a little bit of background about what a CIT is, why we would want to use one, which we, in most cases, we would be wanting to use them. I followed that up with the portfolio construction parameters for the difference between the CIT and the mutual fund. And in my view, that's the biggest thing that you probably should focus on. If you are uncomfortable with the mutual fund construction limits, then we should absolutely change to the CIT. If you're okay with those construction limits, then we shouldn't change. The net effect of these construction parameters on pages 2 and 3 of the memo is that the returns net of fee are lower than the returns in the mutual fund. That's the primary issue in my view. Callan's share class is also relatively short. There's only 20 data points that we can look at, and that makes it hard to be statistically sure that the longer term performance, the savings, let's say, in the Callan share class would be more than the loss of performance leaving the mutual fund. So that's kind of the big issue in my view. At the very end of the memo, I try to illustrate for the board the expected performance differences at the total portfolio level, which comes up to be about somewhere between 2 and 5, maybe 2 and 10 basis points of net performance at the total portfolio level by making a switch to the CL share class. A reduction. It depends on the period. So, it's not always a reduction, but in a lot of periods it is a reduction. The problem is that there's only 20 months of data for it.
So I do have a question for you, because the recommendation was to wait until more data is available.
Yeah.
How long would you recommend waiting? Do you want to see 3 full years or 5 years?
Yeah,
or?
3. I would say 3 years is the least.
Okay, so
Yeah.
maybe we could bring this back if the decision is to wait in another 16 months or so.
Yeah, and that is my intention, and that's what I state at the end of the memo. I would just bring this back when we have the full 3 years. We can look at it then and make the change. If trustees believe that the portfolio construction parameters, they're more comfortable with the CIT, that's a totally different reason to make the switch. If trustees believe that saving management fees in this instance, which would be about $230,000 annually at our current net asset value, if trustees believe that is more important, then we should make the switch. So that's all I have to say about it.
Okay, is there any discussion on the item?
Bring it back in 3 years?
Bring it back at the end of the 3 years, which would be another 16 months or so?
Yeah.
Okay.
I think that's probably,
Suggestion.
yeah, reasonable. So that's basically consistent with the recommended action there, right? Which is to not move right now.
Yeah.
But it didn't say bring it back in 16 months. give
Well,
or take a month or
I think
two.
I did say that, bring it back when we have a 3-year track record.
All the way at the
Yeah.
bottom, but it wasn't part of the.
Wasn't part of the
but
recommended
The
action.
recommended
Yeah,
action at
yeah,
the top of the
yeah.
page.
Right, so the recommended action with the amendment that we come back in 16 months?
Yeah, I don't think it requires an action
No.
item, and essentially, we've taken that as direction from the board now.
Mhm. Okay, let's move on to item D, if everyone's done with item C. And that is preliminary monthly investment performance report. Robert Ravelis, Retirement Financial Investment Officer.
Very pretty, Robert.
Yes, trustees, you have the June flash report. This has most of our public equities and public fixed income updates here, so you can get a good sense of where we ended on a time-weighted basis, which was almost 17.5%. So, you know, we've had another great year. That's excellent. I do want to note on page 2, you can see there's a pending trade of $1.2 million. Some of that was income received early from Barings, and the $1 million there has already been sent to Kane. So we're trying to just fill that allocation up to real estate up. You can see where we're at, about 9.6% of the total allocation. We're trying to get to 11. We expect that in October, we're going to get a larger capital call from LaSalle. We completed the side letter negotiations. We got all that done. We have hired LaSalle now, and we're going to be funding that over the next year. So,
And this is a preliminary report because some of the private items have not been updated, is that correct?
that's right. The only public item is the T row. You might see there on page 4 that T row has a monthly return of 0, and that's because we didn't have the information before we needed to publish the report.
So we'll bring back the final version.
There will be a final version presented for the final quarter of fiscal year 26 in August.
And LaSalle's not listed on this because we haven't invested in it.
Exactly, yeah.
But they'll be showing up soon.
They will.
Questions? Comments? Looks like a pretty solid end to the fiscal year.
It sure does.
Yep. I'd like to order another one for next fiscal year, please.
Kind of get 2 while you're at it.
Yeah.
All right, that will end item 2, investment matters, and bring us to item 3, cash flow projection for fiscal year 26-27 and 27-28. Robert Ravelis.
Trustees, you have the cash flow projection report. I'm going to share my screen and put it up here real quick. And for the last few years, we've been following the same format on this report. We're attempting to project out 2 years to allow trustees to get a sense for what we think our cash position is going to be. And I think there's one big takeaway here, and that takeaway is shown on the second slide here. You can see the blue line is the contribution estimate line here. And you'll notice that that is actually ticking down and kind of flattening out. To me, that's the biggest takeaway. Our funded status has increased over the last few years. We expect that's going to increase. We expect that to continue. And one of the ways that impacts the system is through lower contributions. So on this slide, you can see that blue line is kind of flattened out in the next 2 years. What that means is we expect we're going to need more cash from investments. And we're not exactly sure where that's going to land out, but if we flip to the next slide, page 3, you can see on a purely annualized basis, our projection for fiscal year 27, we need at least $12 million. That's significantly higher than where we've been in the past decade. So you can see in the past decade, we've on an annualized mathematical basis, we've needed $8 or $9 million. In reality, those $8 or $9 million is actually a little bit more than that. I would say it's been closer to $10 million per year. And so with this increase to 12 million or maybe 13 million, we're going to need a little bit more cash than that, potentially.
As a percentage of the portfolio, though, it's staying relatively low.
It is still relatively low. Now, there's one other caveat to this, which is these contribution estimates of 45 million, let's just call them, on the left-hand side here, those values are produced with lower estimates recently from our plan sponsors.
For covered payroll.
For covered payroll. So I have since heard through the grapevine that the estimates that I used here, which were a 1% increase, that's probably going to be low, which would mean that our contributions will go up a little bit, but they're not going to go up that much more. So I guess all that's to say, this report probably underestimates contributions because of underestimation of growth in payroll, and because of the mechanics of how we raise money for operations, our net cash outflow is probably going to be a little bit higher than the 10 million we've needed in the last decade. Probably going to be $13 million or maybe 14.
At our last meeting, the rate of return, I wouldn't say controversy,
Discussion.
discussion. So where does that fit in? Because the valuation study would determine also your contribution.
That's a fair point. So this report does use 2 years of the same rate. We don't have the rates yet for fiscal year 28 because we haven't had our fiscal year 26 valuation. So really, this report doesn't take that into consideration.
That's what
And Robert does, check on the contributions coming in to confirm that the employers and plan sponsors are going to make the minimum required contribution as part of our funding policy. So he keeps an eye on that, and if it was something that he felt necessary, we could always bring an update back to the board. But generally, this is just a high-level overview of kind of where we expect things to go over the next couple of years, and that is that we would be pulling more on a dollar value out of the plan to fund benefits and operational costs.
Yeah, I don't think trustees should take this as an alarm at all. I'm not alarmed by it. It's just something that we'll have to be aware of going forward. I make multiple estimates all month long, every month, all the time. So I'm less concerned about a perceived large jump like this. If we move forward to page 4, this just shows monthly benefit increases that are expected. These tend to be pretty regular. One of the driving factors I think that I've mentioned before is the black portion, the black contribution, the refunds here. The refunds will drive how much cash we need to pull or not pull very directly.
And they're highly variable.
They are highly variable. They could be 10 grand one month. They could be 500 grand another month. They're kind of all over the map. Plan sponsor contributions, again, these reflect the estimated biweekly payrolls, I guess monthly payrolls here. These are, and they reflect lower contributions in total. The next slide is administrative expense. This is pretty variable as well. The more staff we have, the more strategic plans that we put on our plate, the more outside contractors other service providers we decide to hire will directly affect this particular line item. Slide 7 shows the investment sale expectation. As we saw on the second slide here, I am expecting those to go up a little bit, and that's reflected here on this slide. If we look at our net position on the following slide, we can see that we've maintained the consistent low cash relative to our net position for a while, so that's a good thing. No surprises there. On the following slide, slide 9, this just reports our net cash outflow from the second slide. So this is the mathematical annualized cash outflow, not our true cash outflow, versus our net position, which again has been trending down in large part because of our growth in net position. Our cash flows really remain pretty consistent at about $10 million. Slide 10 is the slide that Doris requested we put in last year, and it compares our total cash outflow to our net position. This is also been pretty stable, although it is trended down this year as a result of our large return. And the final slide is a longer-term graphical presentation of the information on slide 10 for ourselves and some of our comparator agencies. And you can see that we have sort of maintained a close to 7%-ish gross outflow as a percent of net position. So overall, I don't think there's any surprises. It's just an awareness that we're probably going to be pulling additional cash from investments to fund operations.
I have a question. Do you know what time period the projections from the payrolls was derived from?
It was the plan sponsor's actual payroll through pay period 13. So
that was what was used to project
the annualized
the future one?
Yeah. Which I think is probably a couple percent low. Yeah. So these use a 1% increase in the next 2 years. I think we're probably going to see 3% increases.
Well, it also is impacted by the county's efforts to reduce the number of employees, which may or may not hold still going into the new year. So
yes.
Correct.
I mean, I think even in the last couple pay periods, there may have been increases also.
But you do see, when we look at the number of total employees from all of our plan sponsors, that there has been a ticking down.
Right.
And that's really driven primarily by the county's reduction in the number of actively contributing members, because they've let people leave by attrition and not filling those positions. Some of that will probably stabilize a little bit. You have a certain mandated positions you are going to hire for, but I don't know what the county's goal is as far as their anticipated headcount or where they want to move to ultimately.
But to reiterate, the effort to reduce the workforce size increases the overall required contribution for the rest of the the participants. So it's,
Well,
it's
the employee portion is obviously separate from the employer
Correct.
side, but that employer percentage of payroll would essentially increase
Correct.
because the actual payroll decreased. And then to get to the same dollar value that's required to be paid to the plan, it's a larger percentage of payroll.
right.
The county has been very effective at lowering their payroll costs. And we look at that every 2 weeks. And, you know, I don't want to speak too soon, but we're actively monitoring where they are today because we want to make sure by the time we get to, let's say, October, that we believe the county is on track to meet the minimum UAL
Right.
payment specifically.
Or to give them a heads up so they can adjust their contributions to ensure that they don't end up with balance due at the end of the fiscal year. Because it is easier sometimes to deal with it along the way rather than waiting till the end. So,
And we don't really get a whole lot of communication from the plan sponsors on what their expectations are for hiring. We really have to wait until we get enough information by payroll that we can look at it on our own and say, okay, we see that, you know, this population is decreasing in number, in count, in dollar pay. So at that point, we would reach out to the county and say something to somebody in the executive office to let them know about that.
and we do this for the court also to make sure that, you know, they can take steps to avoid having balance owed at the end of the fiscal year.
Yeah, so it's an active process. We're watching it like a hawk. That's all. End of my comments. Thank you.
Okay, is there any other discussion on, that was item 3, cash flow? It looks like we will move on to item 4, Mexera Sustainability and Maturity Metrics. Doris Rentschler, Executive Director.
Thank you, Chair Land. This item is actually just brought forth from the February offsite where we didn't have an opportunity to review it. And really, I just wanted to provide some examples to trustees on the types of different measurements that plans and industry organizations use when they talk about sustainability or maturity of a plan. I'm not going to spend a lot of time on this. There were a couple of things I did want to point out, and I wanted to show you Chiron's interactive database because trustees in the past have often asked, well, how do we compare to other California plans? And they have a nice website where it's easy to go in and check for some of these data points that are listed in this particular memo. So Chiron has databases of public plans. They have a large one that covers large national and state plans, but they also maintain a specific database for California public plans, and this is that page. It has the metrics broken out into 4 different categories, and when you click on, let's say, the assumptions tab, you can look at price assumption, wage assumptions, discount rates. Because we've had a lot of discussion about discount rates, I'll pull that one up for right now. So when this distribution of discount rate chart opens, it lands on the median. But what I wanted to point out is that there is a drop down where you can pick any of the plans and see the progression of our discount rate when we select Mendocino over time and where we compare to the median. If you land on any box, it will tell you the specific data for the plan that you had selected for that year compared to the median, and also the ranges of the data point. You can click on a specific year, and it'll bring up a bee swarm to show all the different plans in the database for that particular year that are reporting. You can hover over it and see, okay, San Bernardino had a discount rate of 7.25% compared to our blue dot down here at 6.5%. One thing you can also do is turn it into a plane. It will run through the years of history. Why is it not presenting any data? Oh, there it goes. Because everything was above 7.5% back in those early years. I'm like, why is there no data? But you can see as the plans have adjusted their assumed rate of return, those dots are becoming lower on this screen, and where we are in relationship to our They also have placards for funded status, maturity, and contributions. On funded status, interest cost is one of the items that is discussed, and there's a couple of charts on in the board memo that was provided. That takes your actuarial liability, subtracts your market value of assets, and then determines the interest cost to carry that unfunded liability on that market value of assets, and then expresses it as a percentage of payroll. And again, everything is laid out the same where it opens to the median, but you can pick the particular system you want to look at, and you can also get that bee swarm and see some of the underlying details and how that has changed over time for all the plans. One of the other items that discussed in the report was the asset liability and liability ratios. Those leverage ratios are also called volatility ratios in Siegel's reports, and it also has information on the gross outflows and net outflows of the plans. And I just wanted to let folks know that this was information that was available. We have, again, the tread water rate discussed in the memo, which is kind of that minimum payment required to cover the normal cost contributions plus your interest on your unfunded liability, so your funded status doesn't decrease. It's just if you meet all of your other actuarial assumptions, the minimum payment necessary to maintain the funded status of the plan. And I thought, because there's been a lot of discussion about how we compare to some of our peers, that this information would be of interest, and I'm going to close with that. If you have any questions, I'm happy to address any questions.
Do we have that link?
It is in your board packet. If you go to, let's say, the last slide of my deck, I believe.
Okay.
There's the...
There's a link in the memo.
Page 12.
Page... Cool.
Okay,
One more.
well, we have,
but there is... and if you go to...
We can send that
links,
out
there we go.
to you by email as well.
I'm sorry. That was me. Sorry. Thank you.
Yeah, I can send that out. Access it. You can't.
Are there any questions or comments on item 4? Okay. Anything further?
No, I didn't want to spend a lot of time on that, but there was just a brief discussion about Pew Research and NC PERS and what they have done as far as creating sort of dashboards or trying to standardize some of the measurements for defining sustainability. And I don't need to go into that further, but I'm happy to bring anything back at some point if there's an interest for more information.
So we believe we're sustainable.
Yeah, and one thing I would point out on, let's say, the interest cost graph that was in that board packet is that since like 2016, the trend line has been down, meaning that the interest cost that represents the burden to our plan sponsors is actually reducing. You also see improvement in our funded ratio and a reduction in our unfunded liabilities. So there has been in the past 5+ years a lot of progress made in those measurements as the plan tightened up its actuarial assumptions by reducing the assumed rate of return and making mortality improvements.
And the pension bonds will be completed?
I think they're done.
They're done.
Oh, they're done.
Yeah, that's my understanding anyway.
July 1st was the last payment.
July 1st of
this year.
So like,
Well, they were deducted last year to make the July 1st payment this year.
so a couple of weeks ago, all done. Great.
Okay, I guess that concludes item 4. And will bring us to item 5, Enterprise Risk Assessment Update. Doris Rentschler, Executive Director.
Thank you, Chair Land. The semi-annual update is in your packet. There were a couple of items to note where I actually reduced the rating from, let's say, a green to a enterprise risk assessment. Am I on the right topic? I believe I am.
Yeah, I
Okay.
wasn't on the right topic.
Okay. So there is a dashboard chart attached to that board report, just illustrating the changes in those primary risk areas that had been identified that we are tracking at the dashboard level for the board. For example, on segregation of duties, I changed it from a green back to an orange color because, again, right now we're short-staffed with the lack of a retirement accountant, which we do expect that position to be filled and the person to start on August 3rd. So if you have any questions regarding the risk assessment or any changes in those metrics, I'd be happy to answer those questions. Otherwise, it's just an informational update for the board.
Oh, I think just a comment that I probably would have left the segregation of duties as green, since the position has been funded and is available, and there's a recruitment process, and I believe a candidate selected. I'd have left it green.
Well, I was just perhaps a very pessimistic mood that day. Who knows? We obviously have a plan, had started the change in duties to improve the segregation of things like who creates the journal entry and who reviews it and things of that nature. So that process hasn't really reverted to anything. It's just that right now it's been interrupted while we fill that position.
All right, are there any questions on number 5, Enterprise Risk Assessment Update? Thank you, Doris. And that brings us to item 6, annual unrecovered benefit overpayments and underpayments contribution report. Judy.
Well, this is your annual report regarding unrecovered benefit overpayments and underpaid contributions, and we had none to report this year.
So 0?
0.
Yeah, that's a good number, right?
Yes.
All right, I like that number.
Good job.
2 numbers, yeah. Okay, thank you very much. Any questions or comments? All right, item 7. Quarterly board work plan and fiscal year 25-26 accomplishments. Doris. Wait, I don't have a name for this one. Is this Doris?
It is me.
Okay.
Thank you, Chair Land. The board's work plan calendar is included here. There has been discussion about whether or not we want to move this to be part of the consent agenda in future quarters. In addition to the normal quarterly work plan review there for your reference, I did a fiscal year review of the board accomplishments broken out by the strategic goals, and beyond that, I pulled together a list for the previous 5 years, 2021 through fiscal years 21 through 25, Just as a reminder for the things that the board has provided direction on and your accomplishments over that period of time. If you have any questions, I'm happy to address any questions the board may have.
Does the board have any questions? Seeing none, thank you for that. Moving on to agenda item 8, board policy review. Doris Rentschler, Executive Director.
Thank you, Chair Land. There are 3 policies for board review and update today. The changes to the policies are all relatively minor. There's some minor language changes in the retiree return to covered employment and some maybe minor changes to improve clarity of a couple of sentences in that and in the separate account community property division interest policy. The acceptable use of AI that was just adopted last month is brought back. I brought it back to restructure it to make it conform with our template that we use with other plans. There is also the addition of an additional definition, and that's pretty much the only substantive change, I believe, to that policy. Most of it was just slight improvements to clarify and to a lot of restructuring, breaking out everything that had just been into guidelines into a separate one for like scope for the definitions to be separate and then get to the guidelines that are applied. If you have any questions on any of the policy edits, I'm happy to answer any questions. We are looking at a motion on this one to adopt the policies as amended.
Okay, any discussion or questions? I did have one, if nobody does.
The potential adjustment to the non-spouse benefit. So it's always been there. We've never had to do it. We still don't have an instance where we would need to make a reduction in the amount of the non-member spouse benefit, but we wanted to provide, basically ensure that the parties were aware of that potential and to have documentation that they were notified of it. So that is the only substantive change to that policy.
Right. Any other questions or comments?
So do you want a motion on all 3 of them at once?
Yes, you can.
Okay, I move approval of all 3 policies.
Okay, we have a motion. Is there a second?
Second.
We have a second. Discussion, comments, public?
No public.
No public? All right. Judy, roll call, please.
All right, Ms. Cavanis?
Yes?
Mr. Haschak?
Aye.
Ms. Harris?
Stepped out.
Abstain?
Mr. Swope?
Aye.
Ms. Covison?
Aye.
We have,
Mr. Land?
oh, I'm sorry, Mr. Land. Sorry, forgot about you. Great,
And that passes.
that passes, thank you.
Okay. Which brings us to the administrative report. Doris Rentschler, Executive Director. And
Thank you, Chair Land. As I
I
mentioned,
don't have a link.
we have a new employee starting August 3rd to fill the retirement accountant position. One item that was brought up at the offsite was whether or not the board wished to establish a regular schedule for offsite meetings. The suggestion back in February was that it occur every year and a half roughly, as opposed to every year. So I wanted to get some board feedback and direction on that particular item. I also just wanted to point out that the SACR's Fall Conference registration has opened. We do have 5 rooms held for people who are interested in attending. I believe a couple of people have already provided Judy with their interest and will complete their registration. But please let us know as soon as possible if you would like to attend the SACR's Fall Conference that's being held in Rancho Mirage, which is the Palm Springs area, November 10th through November 13th. There is a direct flight from Santa Rosa to the Palm Springs Airport during that time of year, available on Alaska, I believe, right?
Yep.
Okay. We have upcoming board elections. We will bring you next month the election timeline, but just to let you know, we have the general member third seat, Ms. Kavanagh, whose term ends at November 30th of this year, so there'll be an election for that seat. The retired member, Vince Lekowitz, and the retired alternate member, Mr. Swope, those seats are also ending the term on November 30th of this year, and will be holding elections for that. A candidate for that, or for any of the Board of Supervisors appointees, I did reach out to the South Ukiah Rotary Group and left my contact information to see if they might schedule me an opportunity to come in and talk to their group about serving on the board, but I'm waiting for a call back. The last item I just wanted to mention is the County of Mendocino is migrating their website off their existing platform, Gov Access, to the new system called Open Cities. I believe the target for that is to have it completed around the end of September or sometime in September. And as part of that, Scott Spears will help and migrate all of MSARA's web pages over. So if you have any questions, I'm happy to answer any questions, anything in the board report itself or any of the items that I discussed.
Alex, what will the migration accomplish? I mean,
So the Vision Internet, the original platform, is less than desirable from a variety of perspectives. Most importantly, from the accessibility point of view, which would be the biggest driver. And not only it's owned by the same company, it's their Granicus products. And Granicus seems to be moving people away from the Vision Internet. I don't even think they were aggressively pushing people to move into their Open Cities platform. And not only that, it is time. I mean, we haven't migrated the website. We haven't moved it or done anything else in a long time. And it'll have a new look. It'll give us a chance to clean up content and a much better editor and have some more advanced forms capacities. So on the whole, it'll be a better overall experience. You know, some people there's never been a consensus of what a good website is, you know, and I think this one's shaping up to be pretty good. So, but I'm sure there will be pushback from some people, and most people I think will like the new site.
thank you.
Are there, okay, is there any other questions or comments? I guess we do need to.
I just have one comment. I'm not saying favorable or not to October, but just know that for myself and the fact that there's typically SACRs probably in November, I can tell for myself, I have at least one, maybe two in October already, conferences. So it may be a busier time of year. I don't know what other conferences that some other people may regularly be attending. So it might be a factor for the offsite meeting.
Pension Gold Teaming Conference is in October.
So again, I did ask for some direction on that, and then I kind of forgot about it. But thank you. If there are preferences as far as how frequently or the time of year, we certainly want that information from you.
Yes.
I hope we continue to have the offsites, and I support 18 months. Every year seems a bit much, and every 2 is too long.
I also have a concern about the weather as far as snow.
Yeah, I don't think we'll be going back to Willits, and certainly not in February.
With all the earthquakes and all the snow flurries and.
It would probably be down in this region. We've used some of the facilities, I want to call it the Ag Center, but I don't know what the name of it is, out towards Hopland.
UC Extension.
The Extension Center. That was before my time. They also had done one at the coast a number of years ago. We've also used the Yokeo branch meeting space. So there are some options that would be closer in that would have less potential for snow.
October is a fantastic time to go to the coast. I think I threw out October because it is kind of light on the IT side, to be honest. but it is not light in the treasurer tax collector side, as we know. There's a lot of stuff going on there. So, I mean, any month is agreeable to me as long as it's not February. I think that's not a great choice for the weather, circumstance. I like the 18-month cadence, but it doesn't have to be exactly 18 months.
It never snows in February.
Another idea is the Thatcher Inn in Hopland has a nice room it's about this size.
The inn in Hopland?
Yeah. Yeah.
Thatcher, is that what they? Thatcher, thank you.
So why don't we say this, the direction being 18 months cadence, but it's not exactly 18. It's not on a,
Okay.
And take into account the various, stakeholders here, the trustees, and count of, what month is best or better. There probably won't be a perfect month.
And if there are months like Ms. Gummison said, where you already have a lot of activity with conferences or heavy workload at your office, and so you want to eliminate a particular month, let me know so I can kind of work around those inputs. And I'll bring back a suggestion for the next one, which would happen sometime probably in 27 or early 28, but not February.
No.
Not December either, probably. Okay, that ends our our administrative report, unless there was other questions or comments on that. And which brings us to item 10, general board discussion.
I have a question. How is our shift to Chiron going?
As far as I know, there are no issues. Obviously, they had already started coordinating with Siegel, and so they could build the duplication of the past experience study. I have not heard any issues from Chiron, so I expect everything to be on target without any concerns. We are wrapping up a amendment to their contract. When we issued the contract with Chiron, our contract prohibited the use of AI with any member confidential data, and we are, based on our policy, able to approve it based on the specific use provided by the consultant and how they plan to use it, their AI system. So we're working out those details to execute an amendment to the contract that would allow them to use the tools that are part of their actuarial valuation software.
Okay, Trustee Haschak.
Yeah, yesterday I attended a Callan webinar on options for defined contribution plan participants after retirement. A lot of focus on annuities and different types of annuities, and so it was all right. It wasn't for me particularly, but it was good information. And people can access it if they want to see that webinar. They can go at any time to see it.
They have a variety of webinars, as you know. Some of them cover defined contribution plans, which are more like the 401k and 457 considerations and managing those as a plan sponsor. And then they have some specific to investments or to defined benefit plans. So there's likely something that you might find of interest if you looked at their offerings.
Anybody else with any general board discussion items?
I'd like to just comment on the young men who are part of our staff and how nicely they dress for our board meetings. I would like them to be aware that this whole aura of an almost $1 billion plan, I appreciate.
We'll make sure they know.
Yes.
Well, I was looking at the feedback too on the surveys, and a lot of positive comments about the staff and interactions that people have with them. So I appreciated reading those.
Thank you. When those come in, I route them out to the person who received the feedback so they know that people do respond to those surveys and that they are appreciated by our members for the services that they provide.
All right, I will be out of the country starting this weekend. I very carefully timed my vacation this year to not interrupt any of these meetings. However, we did have a resignation of the application support developer that we have dedicated to Munis, and I'm the backup for that, so we will be real short there. Normally that wouldn't bother me, but I know we do have pending changes to our, we're gonna have a new pay type introduced. So I'm gonna do some testing. I'm gonna get somebody on board. I will not be available. If there's any problems with the transmittal file, you'll have to contact me in Peru.
Again, it's likely that it will
Yeah.
work just fine. I just wanted to give you a heads up in case there was anything that you
Right.
wanted
So
to
to
confirm
test that-
before you left.
Yeah, I'm gonna want some, if you happen to have it, I can find this, but an example of an employee number of somebody who would be
Receiving
subject-
that?
Yeah.
Yeah,
receiving
we
that.
actually do. Judy already has that compiled. I'll have her send it to you.
Okay, yeah, that would be helpful, and we'll test that out, and I'll make sure.
How many,
that it's-
you want a couple of tests?
There's like 55 people who are
55,
eligible.
I'm not gonna test 55, I'm gonna test 2 or 3, yeah,
Okay.
right. Yeah,
Alex, where will you be?
Peru,
Have fun.
yeah,
Safe travel.
Gonna hit Machu Picchu while you're there?
no, no. That's a one-time experience.
Have you been?
I have, my
I
wife's
have
from there, I go there all the time, so, but Machu Picchu one time is fine, no more than that.
Is there hiking involved for Machu Picchu?
No,
Well, you can
but
take
it's
the
a
train.
long day,
Oh, okay.
yeah,
There's a train, right?
there is a train, you have to get there by train.
What about the Galapagos?
Hmm?
Galapagos Islands, are you going to?
I'm not going to the Galapagos. No, that's part of Ecuador, and it's 1,000 miles offshore, I believe.
Oh, is it that far?
Yeah, it's quite a ways.
Can't swim.
It's a long ways. Maybe not that far, but it's a long ways out there.
My professor at the University of Minnesota, his uncle was the person who I would say popularized, because the locals knew of Machu Picchu for years, for centuries, but he
Yeah,
introduced it to the world, you might say.
right, right. Okay, I believe that will wrap up our general board discussion.
It is, yeah.
Unless there is any other general board's discussion. And that will bring us into closed session where we have one item, public employee performance evaluation, executive director pursuant to Government Code Section 54957. Thank you. Anything beforehand?
Scott? Yep. Oh, okay.
Okay, we are back in session, and we're going to start with item number 12, report out of closed session. Board met, and the executive director received her annual evaluation. And that will bring us to item 13, adjournment and notice of next board retirement meeting. The next board of retirement meeting will be held in the... I hope all that came through. Do I need to do it again? I didn't have my
Probably
microphone
do
on.
it again, just.
Let's do it again. Let's go back to 12, report out of closed session. The board met in closed session, and the executive director received her annual evaluation. And that brings us to item 13, adjournment and notice of next Board of Retirement meeting. The next Board of Retirement meeting will be held in the Board of Retirement Conference Room, 625B Kings Court, Ukiah, California, on Wednesday, August 19th, 2026 at 8:30 a.m. Thank you very much.
Thank you.